Hey guys, welcome back to the latest episode of the Growing a Dental Practice podcast. I am your host, Mike Hennon, and I'm joined today by special guest Warren Robbins. Warren is an income protection specialist for dentists and medical professionals, and he's going to tell us all about that today. So, Warren, why are we talking about income protection on a podcast all about growing a dental practice?
That's a really good question. Now, dental professionals have a very highly tuned skill set. They need a lot of training to develop their skills. And when they go into practice, they use those skills to get a return on the investment. So they put a lot of time and often a lot of money into becoming a dentist. One of the issues that you have with that is because of their quite specific skill set, they're more vulnerable than most people when it comes to things that can stop them working. They have incredible motor skills, so they're working with very small instruments and very delicate instruments in a very precise way. Now, if they have some sort of hand injury, sort of if they have an accident and sever a tendon or nerve in their hand and they lose some of their motor skill function, they may never work as a dentist again. And that's a risk for them, which it isn't for most people. If I sort of lost a finger, my really mediocre typing skills would be even worse, but I'd still be able to do my job. If I lost a finger as a dentist, my career is pretty much down the pan. They also have issues with they need really good eyesight, so any eye problems could potentially stop them working. And one of the more common things as dentists sort of move through their career is back problems. So they're leaning over in sort of maybe not the ideal position, and they can get back issues as well. So they're more vulnerable to things that will stop them working, which wouldn't stop most of us working. So that's why income protection is particularly relevant for dentists.
And why would it be so important for the person starting a practice?
To set up your own practice, it's obviously a pretty serious financial commitment, and the return on that investment and commitment is going to be the income that's generated from the activities of being a dentist and running the dental practice. And even if there's a number of other dentists working in the dental practice, normally you'll find that when a dentist starts their own practice, they're also quite reliant on their own income because they're not going to generate enough surplus income purely from the dentist that they may employ to get the return that they need to make it a viable proposition. So it's really important that if they're unable to work, they've got some sort of income replacement available to compensate for the loss of income from working activities. And with the sort of typical income that dentists generate, you can actually insure up to about 89% of your post-tax income. So you can actually get a lot of income replaced through income protection.
Excellent. Perfect. And that, guys, is why we're talking about income protection on today's show. So I'd like to go back a bit and just say, tell us a bit more about you, Warren, because I know you quite well now, but I want the listeners to learn about you as well.
Okay. I'm a fairly unusual sort of creature in the world of financial services. I started off doing something very, very different. I began life as a research chemist. I'm a chemistry graduate. I worked in research and development for over 20 years in the UK and the USA. And from doing that, I've got a skill set which involves a lot of research ability, and also a hell of a lot of maths was involved. So I'm a sort of fairly natural mathematician and a researcher. Now, when I decided around about 2004 that I was going to switch careers, I was looking at what skills I had and where they could work. And when I looked at financial services, I thought the mathematical side of stuff would fit really well. And I've got reasonable people skills, so I thought that's the thing to go into, which I did. If I'm honest, I didn't think the research skills that I developed were going to be of any use in my sort of second career, but they've actually turned out to be probably more valuable than the mathematical skills. And we'll probably cover that a little bit later. So in terms of people that work in financial services, probably there's, with my sort of background, is probably me and probably no other. So I'm a little bit different.
A little bit odd, but yes. Good odd. And you're a nice guy, so that always helps. So I've just realised we've kind of just mentioned about your background. We've talked about why income protection is important, but I've kind of just skimmed over the fact that not everyone listening will probably know exactly what income protection is. So can you just give me like a high level view of what that is for the uninitiated?
Yeah. For people that aren't fully aware of what income protection is, and probably that includes some of the people that actually have income protection, because often the advice that comes with buying a policy may not be that great. So in essence, if you break it down to the fundamentals, income protection is the world's best sick pay scheme, and it's one that you buy and you control. So it's something that if you get it set up correctly, as I said slightly earlier, you can cover up to around about 89% of your post-tax income. So you can replace a big chunk of your income if you're not working. It's something that, unlike most sick pay schemes, it's yours, so you control it. So you pay the premiums and it's going to be there. Nobody can cancel it. It'll pay out if you can't do your own duties, and that's an important thing. If you set it up correctly, there are various definitions or cover definitions with income protection. If you get the right one, if you can't do your dental duties, it will kick in after your chosen waiting period. Now, the waiting period is something that if you have some NHS sick pay through the Associate Dentist NHS sick pay scheme, it normally kicks in after that. If you mostly private work, you'd probably have a shorter waiting period, and those things influence the overall cost. In terms of how long that sick pay would pay out for, most people would have it running through to the end of their working career, though there is an element of that which probably you need it running longer than what you may plan as your career, and we can probably cover that a little bit later. So in essence, it is the world's best sick pay scheme that you can buy off the shelf, and with good advice, there's nothing better in terms of illness protection. And the Consumer Group, which actually say that it's the one insurance policy that all working adults should consider, and they're pretty unbiased. So, and it's something I fully sort of endorse as well. I think it's a great comment from them.
Excellent. That's a really good explanation of what income protection is and why, why it's so important. So I guess that's one of a number of insurances that you can get as an individual. People talk a lot about critical illness. How is that different from income protection, and which one should you prefer? What's the preferred option really, or what should people choose?
That's a really good question. I would say the majority of people, when it comes to illness cover, take critical illness cover. And one of the big reasons for that is that they tend to take it through mortgage brokers, and the default offering for mortgage brokers tends to be life and critical illness to cover the mortgage. In my view, it's a little bit short-sighted. And the reasons for that is, if you look at critical illness, it covers a list of conditions. All of those conditions have fine print, and you've got a fixed lump of money. So it's a lump sum payout, and it's designed to pay off the mortgage typically. The reality is, when people actually claim on critical illness cover, they don't tend to pay off the mortgage. In fact, it's very rare they pay off the mortgage in full, because at that point, the penny drops that they have lost their income. Because if you have cancer, or you've had a heart attack or a stroke, normally you're unable to work. So therefore, people aren't paying off the mortgage, which they thought they would do because they haven't really thought it through. They're then drawing on that money to pay the bills, because those bills don't go away just because you've had cancer or a heart attack. And that pot of money, if you can't go back to work for a prolonged period, that pot of money could be fully used up, and you've lost your critical illness cover and you've lost your life insurance, because they're invariably life or critical illness cover. Income protection, there's no fine print. It pays out after your chosen waiting period if you can't do what you do for a living, and it continues to pay out until you either die, which is where the life insurance, which you would also have, kicks in, you recover and return to work, or you reach the end of the policy term, which is sort of retirement or thereabouts. So in terms of the comprehensive nature of it, income protection just covers you for pretty much everything. And if you look at the claims for income protection, around 60% of the claims are for musculoskeletal problems, stress, anxiety, depression, and just good old accidents. And none of those 60% of the claims that are paid out for income protection would receive a penny for critical illness cover, because they're not. So you could be off work for a prolonged period of time, and your critical illness cover doesn't pay out because it's not designed for that. So for me, income protection is by far the best illness cover there is. And as long as it's covering all of your outgoings, so it covers your mortgage payments, your bills, if you never work again, your mortgage won't be paid off in a heartbeat, but you'll just pay it off over the full term it was originally intended to. And that's how income protection for me is vastly superior. It covers all eventualities. In the perfect scenario with critical illness cover, if you have a heart attack and you're off for 6 weeks and you've got 6 months of sick pay, fantastic, your mortgage is gone and you've lost no income because you've got your sick pay. But there's a lot of scenarios it doesn't work very well. Good income protection policy set up correctly covers you against pretty much every scenario you can think of. So that's in a difference.
So is it a case of you have one or the other, or would you have both?
In terms of the hierarchy, I would always start with income protection because it covers everything, and to a degree, I would view the critical illness as almost like a bit of a luxury. If you want to make sure that if you do have a critical illness, that as well as you've got the backup of the income protection policy, you'd like to get rid of your mortgage just to as almost like a belt and braces approach. It's not absolutely necessary, but if people want to have that extra reassurance, it is something that you can certainly take. And there is I wouldn't argue that there is definitely a place for it, but it's more about sort of additional peace of mind. But if you've got the correct income protection cover, you're going to be financially secure regardless of what happens. But some people want both. Essentially it's a belt and braces approach.
Yeah, perfect, brilliant. Thank you, Warren. So there are quite a few big players in the income protection market for dentists. We've got Wesleyan, there's Dentist Providence, you've got Vitality. What the best? I'm just thinking the best way to describe this. Why should a dentist listen to this show consider someone other than them, or if they're with them now, why should they consider maybe looking around and seeing if they can get a better offer?
The short answer is money. It's going to cost you potentially a hell of a lot if you with one of those providers. The longer answer is that when you look at income protection, if it's set up correctly, you'll have it so that it increases in value. Your payout increases every year to protect it against the cost of living increase. And to demonstrate why you would need that, with the current levels of inflation, in 10 years, with the current level of inflation we have at the moment, the value of your payout, whatever it is on day one, in 10 years' time, it'll be worth half of what it is now. So it makes sense if you take income protection pretty much every time that you have it increasing every year by whatever the cost of living increase is. Now, that cost of living increase is not shown in terms of the impact on premiums on insurer illustrations. So if you have a policy which costs £10 a month and it's a 30-year policy, the cost shown on the illustration will be a little bit over £4,000. The reality is, if inflation stays what it has been sort of typically over the last 30, 40 years, you're going to pay somewhere between £7,000 and £20,000 for each £10 worth of premium. Now, that's a hell of a difference. So if you've got a £50 a month policy, which is not excessive by any stretch of imagination, you're looking at something between £35,000 and £100,000 for the total cost. Now, why you should be concerned if you're with Wesleyan, Dentist Provident, or Vitality is that those three providers, they dominate the market with dentists, but they are also, with the methodologies they use when they're their cost of living increases, they're the most expensive three. So ask yourself, do you want to be spending £7,000 for every £10 worth of premium or £20,000? And if you prefer to be spending the 7 rather than the 20, you shouldn't be with Wesleyan, Dentist Provident, or Vitality, because they will cost you an arm and a leg. Now, as I said, sort of, it's not shown on the insurer illustrations. The way they can actually legally mask the true cost of the cover is because nobody knows what the future cost of living increases are going to be. So what they do, they make an assumption that the premium never changes to reflect the fact that the cover is increasing, and they put a little disclaimer in saying the figure shown does not include any increases in premium due to increasing cover. Now, I've never spoken to a dentist or a doctor yet that actually understands the impact of that little disclaimer, because it's obvious, it's there, but it's not in bold, because they don't understand the power of these annual increases. and it's compound interest. And Albert Einstein referred to compound interest as the most powerful force in the universe. Those little increases add up over time, and it's really, really. Well, I think it could be the next mis-selling scandal. To be honest, you've had payment protection insurance, you've had endowments. I think this, when you've got something that is likely to cost you £100,000 and it's telling you that it's going to cost 20, I think it's wrong. So what I do with my dentists is I look at their policy, I show them a realistic projection of what it's likely to cost, and I then look at what is available and show them the savings that they can make. And from the dentists and doctors I've worked with so far, the average saving over the full policy term is over £40,000, which is a crazy amount of money.
Ridiculous, actually ridiculous. So I was going to say, like, I'm glad you touched on the kind of the small print aspect of it, because I was like, dentists are intelligent people. They would spot that from a mile away, but it's so hidden and so
it's
ridiculous. I can't believe they do it.
And if you don't appreciate the power of indexation and compound interest, it's which pretty much nobody does. Because of my background, I'm a mathematician, I'm a researcher. First of all, it took me hundreds of hours of research going through policy documents in detail to find the mechanisms that the insurers use when they apply their annual increases, because they don't show them on the illustrations generally. They're hidden deep in typically 80-page policy documents. And that's where the research skills came in, because when I moved into a new field, I wanted to find out how these policies worked. And when I found out how they worked, I was staggered. And then I did the maths and modeled, and I spent another hundreds of hours modeling these spreadsheets so I could actually calculate the cost of every insurer that's available for every client. So I can do a full illustration for every option and work out who's the lowest cost, bar none, factoring in future cost increases as well.
So like a potential client could sit down with you thinking that they've got a good deal with one of the big providers, and actually you'll be like, actually no, if you really factor everything in, and over time you're going to pay this amount, which is significantly higher than hopefully what I can help you with, which I just find is unbelievable.
It is, and particularly, I don't want to sort of badmouth any particular insurance providers, but there is the methodology that tends to be the most, in my view, insidious is where they apply the age costed increases. So Dentist Provident in Wesleyan and AIG, another insurer, they apply the amount of cover at the age you are, the cost at the age you are when you take it. So it's not too bad when you're young. So if you take out a policy as a 30-year-old dentist, the increases don't seem too bad when you're young. But when you get into your 40s and 50s, the increases get bigger and bigger. And with those age costed increases, they tend to be 11-12% per year for a sub 3% increase in cover. So they get really expensive. And if you've had any medical conditions or ailments, or you've made a claim on a policy, it then becomes almost impossible to switch the policy, because that condition will be excluded if you switched cover. And I've got a dentist client who is with Dentist Provident. He's paying nearly £500 a month for his income protection cover. Now, I could switch him to a policy for £300 a month, even now, and he's in his 50s, but he's claimed on a neck injury, and that neck injury is being managed through physiotherapy. So if he switched to a lower cost provider, that condition will be excluded. So he can't change, basically. So he's stuck. And I think the insurers know this is likely to happen. So effectively, you can't switch. It's almost like having negative equity on your mortgage. You're stuck where you are. You can't change because the consequences are too risky.
Yeah, I was going to say, do you think it's most cases where, say, a dentist signs up to income protection fairly young or fairly early in their career, and then they kind of it just sort of sits, they forget it, and sort of is out of sight, out of mind. They know they've got it, so they're not worried about it. But it's only when maybe they have an issue that they suddenly realise, actually, it's quite expensive, or I'm locked in now. And
yeah, 100%.
Quite a common case.
Yeah, 100%. The reason that the market is dominated by Wesleyan and Dentist Provident is that they're very, very effective at marketing. They tend to go into dental universities and present their propositions when people are training. So they sign up a lot of people when they're still at university or just come out. And when you move into a new job, the last thing you're thinking about is, shall I start reviewing my protection, because you're in a new career and it's pretty demanding. And because of the way they apply their annual increases, they're very subtle. They're quite low to begin with. So the impact only really starts to sort of, or the chickens come home to roost when you get a little bit older. And it's a really clever technique. And it gets unpleasant, but if you've got perfect health, you can switch even in your 50s and save a lot of money. But a lot of people don't. Most people, if you've been leaning over somebody for nearly 30 years, you've probably got a back problem to a degree that you may be managing. You might have had the odd claim, and you can't switch. So it's catch-22. You're stuck. So yeah, I think it's, from a business strategy viewpoint, what they do is very clever. But if ethically or morally, I'm not impressed by it, to be honest.
Less so.
Yeah,
that's fair. So you said they sort of increase gradually. So at what stage in the life stage would it start to like ramp up quite quickly? Typically,
probably when you move from your 30s into your 40s. You start to see the premiums increase. So because the cost of income protection gets more expensive as you get older. As you get into your 40s, it gets significantly more expensive, and get into your 50s, it gets a lot more expensive. So that's when you really start to realize that the costs. But because you've got a policy that's already in place, you may have to bite the bullet and pay slightly more in the short term, because taking a full new policy at an older age is obviously fairly expensive. And again, the insurers know this. So again, it's another clever strategy. So you may have to pay 10% more to switch policy sometimes, but to get something in, it's going to go up at a much slower rate. So, and most people don't know the mechanisms and don't model the long-term costs. So they'll look at their existing policy, which has just gone up by 12%, and sort of look at a comparable policy, which is maybe 10% more than they're paying. So they'll think, I'll stay put because it's still cheaper than switching, not realizing that one that's 10% more expensive now, in 5 years' time, will be 15% less expensive and continue to get cheaper relatively.
Yeah, excellent. So you mentioned that the average saving that you've had with clients is around the 40k mark, which is amazing. I'd love to know some of the higher numbers.
The highest saving I've got was for a dentist with Wesleyan. He was paying he had a big monthly premium, around £200 a month, and switching his cover, the projected savings with the average inflation rate, as it's always been, would be around £101,000. Now, some of that was because
100 grand.
Yeah. Now, that wasn't. Some of it was because his policy was set up incorrectly. His deferred period was too short, because he wasn't aware of the NHS associate dentist sick pay scheme. So he got his policy set up with a 1 month deferred period, and it wouldn't have paid out until month 6. So that was set up incorrectly. He also had too much cover, so he couldn't claim the amount of cover that he had because he was overinsured. So there were a lot of things wrong with his policy, and setting up a policy with the correct amount of cover, correct deferred periods, and with a lower cost provider. The savings were just over £100,000, 101 and change.
So the fact that he was overinsured, was that an issue caused by sort of the protectorate, the income protection, like sort of Wesleyan in the first place? Like, had they set it up wrong, or had his circumstances changed and they hadn't reviewed it with him?
I think from experience of dealing with people who are getting quotes from Wesleyan, they don't tend to check people's income a great deal. I had a client very recently that was looking to increase their cover, and they told Wesleyan the amount of cover they were with Wesleyan. They wanted to increase it to a certain amount, and they got a quote back from Wesleyan. When I checked the amount of cover, Wesleyan wouldn't offer that amount of cover, so they'd actually sort of quoted for around about 15% more cover than their maximum allowable based on her income. So they're not giving advice. If you go to most of the insurance providers, what they do is they will arrange the policy, they won't advise on it, which means effectively you are saying, if you go direct to an insurance company, I'm the financial advisor, and the onus is on you then to get the correct cover. If you go through a financial advisor or an income protection specialist, they then take the responsibility to get it right away from you. And if anything goes wrong, you're then covered by the Financial Services Compensation Scheme, which you wouldn't be going direct if you've taken out the wrong cover.
Okay, so that makes sense. That again just seems like another reason not to go to one of the bigger players, because they're just not. It's almost not in your best. They're not doing it in your best interest. Like there's no.
If you sort of use an analogy, if you were looking to get a television, would you just go to the Sony shop, or would you look at all of the other TV providers? If you go to Sony, you come out with a perfectly good TV, but a bit like Wesleyan and Dentist Provident, you're also going to pay through the nose for it, because there's a premium that comes with those sort of brands, and you might well get something that is, in terms of performance, significantly better than the Sony TV, and it'll probably cost you half as much as well. So I think there's parallels between TVs, come to think of it, and income protection. So
yeah, okay, so I guess it does kind of happen in a lot of industries, but we're just obviously specifically talking about the income protection market.
Yeah,
no, that's brilliant, Warren. Love that. So earlier you mentioned that typically a dentist is going to have cover up until their retirement age, or their planned retirement age. But in what cases does it make sense to maybe extend that, or is there a reason for extending it beyond that?
Yeah, absolutely. I would say a lot of the dentists I speak to, they're aware that it becomes a more difficult occupation to be in past about 60. So they plan to retire at 60 because they worry about their back and all the other bits and pieces that go with that sort of job. Now, then typically the setup for the income protection that I see them taking is they take their income protection to 60 because that's their planned retirement age. Now, superficially, that sounds like a perfectly reasonable idea. You retire at 60, so why do you need cover past 60? Well, what I do is scenario sort of planning. I look at what happens if. Now, if you're taking income protection, you're taking it because there's a possibility that you may lose your income, and therefore you'll be relying on the income replacement from the income protection policy. Now, if that happens, you are then not earning your full income. So if you're planning to retire at 60, typically those plans are based on you earning your full income through to the age of 60. So you accumulate the wealth that you need to retire by 60 by working all the way through to 60. Now, if something happens and at the age of 40, you have an accident and you can never work again, and you're then claiming a reduced income through income protection policy through to the age of 60, you will not accumulate the wealth that you need to retire at 60. So therefore, what I normally do is to say, if you add maybe another 5 years onto the policy, and if you end up claiming on your policy, you've got another 5 years that you can accumulate that wealth from the scheme and put that in to retire, and then retire, even though you're just not working, so you're effectively not retired now. So it's set up, the cost difference between a premium that runs to, or a policy that runs to 60 versus 65 is not significant. It is a bit more, but it's not catastrophic. And if you never claim on it and you reach 60, you then cancel the policy. So you don't have to be paying those premiums between 60 and 65. In fact, it's almost, you probably never would pay those additional premiums between 60 and 65, because if you've worked throughout and you've never claimed on your policy, you retire at 60, you cancel your policy. If you're not working and you're claiming on the policy, then you're not paying the premiums because they're covered by the policy when you're claiming. So it's pretty much impossible that you would ever pay those premiums between the age of 60 and 65, but you have the added benefit that it's there if you need it. So so that's
great. So
I would normally add 5 years on, because if you could claim, you're going to need it.
Yeah, so it's a great way to sort of top up your pension pot kind of thing.
Absolutely. And another thing is sort of people, when they look at the amount of cover they're taking, it's fairly normal that they would cover their outgoings. And they go, I pay out this, I've covered my bills, I've got my mortgage, I've got my car loans, I cover everything. What they don't think about covering often is the money that they would want to put away for their retirement. So if you only cover the costs on your outgoings as they are now, without having a provision for your retirement funds, you're going to reach your retirement age, you've covered all your costs, and you've got no pension to fall back on. So the other thing to think about is, as well as having that extended duration, make sure you've got something to invest for your future retirement if you want to have a retirement, regardless of whether you can work or not. and
Mhm.
few people
Excellent.
do. So it's about thinking through in detail what would happen if, and most people don't.
Mhm. Mhm. And again, that's just another advantage of going to someone like yourself that's thought that through. Whereas most people, they say 60. The person on the other side, it's just said, okay, right, we'll do that. We'll do exactly what you say, but we're not really thinking longer term. They probably wouldn't be able to explain, actually, you're going to pay a little bit more on your monthly premiums up to 60, but the benefit is this.
Absolutely.
They'll just sort of take it at face value, right? 60 is where we're going to stop, and that's it. So again, sort of another reason to sort of speak to an independent advisor like yourself.
Yeah, and
So,
if I'm switching them from one of the more expensive providers, if you look at the total cost of my recommendations, they are typically significantly cheaper than an inferior level of cover. So good advice is the key when it comes to these things. If you're going to spend good money, hard-earned money on protecting yourself, make sure it's doing the right things and you're getting good value for money and properly protecting yourself.
Yeah, excellent. Perfect. So we're starting to, gonna let your cat out.
Yeah, cat's out the bag.
Honestly, I love that. Honestly, there was a moment I was like, is there a baby in Warren's office? And I was like, oh no, it's a cat.
Yeah, it's office cat.
Excellent. Love that. So yeah, starting to wrap up. So a couple of sort of last questions is, so if I say I'm a dentist and I'm currently got income protection with one of the big providers, what should I do? And what will make me think, what should I do next? Is basically if they've listened to this and they're with a big four or the big 3 or 4, what should they do next?
I would say speak to an income protection specialist. I'm available as one of those. There aren't many people that have specialized in this field. It takes a lot of initial time and research to generate the data to be able to fully understand the long-term cost of these policies, and also then think through what is actually best, because dentists and doctors, they're professionals. They deserve the best standard of cover available, and the best advice. So whether it be speak to me or somebody that does something similar to me, I'm not particularly aware of anybody that does that, but I'm available. This is what I do. This is my speciality. I've moved into the doctors and dentist field, initially through accident, through my own dentist, where I sort of started looking at his cover and realized the savings I could make. And off the back of that, through various referrals, it's grown and grown. And now it's what I work in. It's my field and my speciality. So I'm available to help with anybody. So, and what I will do, if I come across somebody and the cover they have is doing the job and it's doing the job well and there are no savings to be made, I'll tell them to keep the cover they have. The main priority for me is always top quality advice and working in an ethical way. So it's not something I come across that often, but I do come across dentists where I say, stay with what you've got, you can't beat it, and doctors. So I'll give an honest opinion. And for most people, like I said, my average saving for dentists and doctors so far is around about £40,095. And would you rather have that money in your back pocket or in the insurer's profit and loss account? So, that's the question I'd ask you. So if you don't like overpaying, give me a call or drop me an email.
I think that probably summarizes it. Would you like to save £40,000? Yes, come talk to Warren. So Warren, if they wanted to come and talk,
£40,000, that's the question I would ask you.
Yeah. So Warren, if they wanted to come and speak specifically to you, how can they do that? How can they reach out? Where can they find you?
You can get my contact details on the MediDent FS website, so www.medidentfs.co.uk. My contact details are on there. They're also available on the Dental Business Alliance website, so my contact details on there. I'm part of the alliance, and I'm happy to give my details out now. So
perfect. Go for it.
Yeah, my mobile number's 07977 093361. And my email address is wrobbins, and that's a single B in Robbins, at medidentfs.co.uk. And that's medidentfs.co.uk. So yeah,
perfect. And you're also perfect. You're also on LinkedIn. And I will also include your contact details in the show notes so you can get them there.
Fantastic.
So, Warren, thank you so much for your time today. Really appreciate you. Oh, is that a client?
Probably a cold call.
I didn't realize this was going out live. So, Warren, thank you very much for your time. Really appreciate you explaining, in detail, because obviously income protection is kind of it's something sort of shrouded in mystery. So you kind of sort of debunked it and explained, kind of why the current providers probably aren't acting in the best interest of some of our dentists. So if you do have income protection with Wesleyan, Dentist Providence, is it Providence or Providence?
It's Dentists Provident.
Dentist Providence or someone like Vitality, then please get in touch with Warren and just see if he can save you money. I have no doubts he can, but just we don't. The last thing you want to do is waste a lot of money on something that you could get elsewhere. So please do that. So that is about it. So Warren, thank you again, and I will see you at a DBA meeting soon.
My pleasure. Thanks for your time, Mike.
Perfect. Cheers, Warren. Bye.